An SBA 7A loan will save you tens of thousands in interest, but it takes 60 to 90 days to fund. If your payroll is due Friday, that timeline might kill your business before the loan saves it. Today we're breaking down exactly when to chase an SBA loan, when to go alternative, and how the 5-minute rule changes everything.
Yeah. I mean, it is basically the ultimate balancing act, for any business owner. You are
Yes.
constantly weighing the literal cost of capital against just the absolute necessity of momentum.
Right. And in this 2026 landscape, the penalties for miscalculating that balance have just, well, they've never been steeper,
Yeah.
which is the core mission of our deep dive today.
Absolutely.
We're bringing in a massive stack of sources for you guys. We've got the Federal Reserve's 2026 Small Business Credit Survey, lending tree reports, plus some really deep data from Crestmont Capital.
And don't forget the speed to lead benchmarks from Apton and Kixie. Those are eye-opening.
Oh, for sure. The mission here is to help you navigate an environment where the speed of money is just as critical as the cost of money. Okay, let's unpack this. We need to start with the macro picture.
Yeah, let's do it.
According to that Federal Reserve survey, the traditional path to getting cash is, it's functionally blocked for most people right now.
It really is. We're looking at a profound structural disconnect the economists are calling the credit wall. Traditional depository institutions, your massive commercial banks, they've aggressively tightened their underwriting.
Right.
Right now, they're only approving about 13 to 21% of small businesses that apply.
Wow, wait, so almost 4 out of 5 businesses are walking into their local bank asking for capital and just getting a flat no.
Exactly. And the data from Crestmont Capital shows these aren't just like failing businesses. A lot of these are healthy, revenue-positive companies. They have solid track records.
So why the mass rejections?
The banks are simply shedding risk. But, businesses still need capital to operate, right? So that credit wall is aggressively pushing owners toward the non-traditional lending market.
Which is massive now.
Yeah, it's ballooned into a $67 billion industry. That shift fundamentally changes the rules of the game. You're no longer sitting in a quiet branch manager's office.
Right, you're entering this highly fragmented, highly aggressive alternative market, which brings us down to the micro-reality of a business owner staring at a cash flow gap.
It's a stressful place to be.
Oh, incredibly. The paradox between cost and speed here is just wild. On one hand, you have the gold standard, SBA loans. The rates are incredible. We're talking base rates around 5.6 to 14.5%.
And you get these really long 10 to 25-year repayment terms.
Yeah, but the friction is the timeline. They take 60 to 180 days to actually hit your bank account.
Right. And on the other end of the spectrum, you have the alternative lenders. They can literally drop cash into your operating account in 24 to 48 hours.
Which is insanely fast. But the catch, obviously, is the premium. We're seeing effective APRs in the alternative space ranging from 15 to well over 80%.
The steep price for speed.
It's like choosing between taking a bus cross-country for $50, which takes a week, or chartering a helicopter for $5,000 because you have to be there in an hour.
That is a perfect way to look at it.
But wait, let me push back on this for a second. Shouldn't a well-run business always plan ahead and just take the bus? Like, if you're managing cash flow correctly, shouldn't you always have the luxury of waiting 90 days for cheap money?
What's fascinating here is that human psychology and operational reality rarely afford us that luxury. In behavioral economics, we look at this speed-to-fund decision window.
Okay, break that down.
Capital needs generally fall into 3 psychological states. The first is crisis. This is an urgent payroll shortfall or, say, a catastrophic equipment failure. Your window is 24 to 48 hours.
You don't have time to wait.
Exactly. The second state is maintenance. Think seasonal inventory ramps or standard hiring cycles. You have a 2 to 4 week window.
Right, a bit more breathing room.
Yeah. And the third is opportunity. That's a major market expansion or acquiring a competitor where you have a 1 to 3 month window.
So the traditional metrics of creditworthiness, like agonizing over a 2% difference in an interest rate, they just evaporate in a crisis state.
Completely. The existential threat to the business outweighs the cost of the debt. If your operations freeze on Friday, a 6% loan arriving in August is functionally useless.
Picture this. You run a landscaping company, and it's March. Spring is about to explode. A commercial property management company calls and offers you a $400,000 seasonal contract.
That's a massive win.
Huge. But you need 2 new mowers, a skid steer, and enough working capital to cover crew payroll for the first 60 days before their first payment hits. You don't have 90 days for SBA.
No, not at all.
You need equipment financing and a line of credit funded this week.
Yeah.
By next Monday, the equipment is delivered, your crew is hired, and you're on that job site.
And that speed literally saves the deal.
Exactly. That contract pays for the financing 3 times over by September.
The alternative market exists entirely for that scenario. Yes, the cost of the capital was objectively high, but the hidden opportunity cost of declining that $400,000 contract. I mean, that would have stunted the company's growth for an entire year.
If you just realize you don't have to choose between speed and cost, stick around because we're going to show you how to leverage both.
Yeah, it's a game changer.
But first, we really have to look at how this urgency changes the behavior of the people actually lending the money.
Because the borrower is operating on this compressed timeline, right? It creates an intense arms race on the lender's side. The speed of the lender's response makes or breaks their own business.
Here's where it gets really interesting. You would think in a highly digitized 2026, a financial institution would be instantly responsive.
You'd hope so.
But the benchmark data from Kixi shows the average B2B lead response time is a dismal 42 hours.
Which is an absolute eternity when a borrower is in that crisis or maintenance state. This introduces what the industry calls the 5-minute mandate.
Okay, tell us about the 5-minute mandate.
The data on this is incredibly unforgiving. In financial services, 78% of customers buy from the first business that responds to their inquiry.
Oh, wow. So nearly 8 out of 10 business owners aren't, like, building a spreadsheet to evaluate offers.
Not at all.
They're just going with whoever answered the phone first.
Speed has basically become a proxy for reliability. If a lender responds to your funding inquiry within 5 minutes, they have a 400% higher qualification probability.
That's a massive jump. What if they're a little late?
If they wait just 30 minutes, their odds of qualifying you drop 21 times. The decay of a borrower's intent isn't some gradual slope, it's an absolute cliff.
Because if I need money by Friday, I'm not waiting by my email. I'm filling out 5 different online forms until a human talks to me.
Exactly. Which totally explains the massive shift toward AI we're seeing in the Apton reports.
Right, the AI agents.
Yeah. Human loan officers have structural bottlenecks. They sleep, they go to meetings, they take weekends off, an AI agent responds in seconds.
Eliminating that whole weekend lag.
Completely eliminating the 61-hour Friday to Monday gap where traditional pipelines just bleed out. When you apply for alternative funding in 2026, you are almost certainly being triaged by an AI within seconds of hitting submit.
It pulls your credit profile, evaluates your revenue, and decides if you're worth a human's time before you've even closed the tab.
It's wildly efficient.
It really is. But let's shift gears. We've established the extreme premium placed on speed. Now I want to talk about the scenarios where you absolutely should endure that 60 to 90-day wait.
Right, the SBA side of the ledger.
Exactly. When is waiting for the gold standard the right move?
You endure that timeline when you are firmly in the opportunity state. If you have 60 to 90 days of runway and your success relies on the lowest possible overhead, the SBA is unmatched.
Like buying commercial real estate, heavy equipment, or a business acquisition.
Yeah. And we should clarify the difference between the products, right?
Yeah.
Because SBA loan is just an umbrella term.
Right. There's the 7A loan, which we mentioned in the intro. That's basically the Swiss Army knife, working capital, partner buyouts, whatever. But then there's the 504 loan.
The 504 is highly specific. It's designed for major fixed assets. And the terms are what make it so attractive. You're looking at 25-year repayment schedules.
Which you just can't get from a fast alternative lender.
No. Their risk models won't allow a 25-year term.
Let me put this in real terms. You own a growing plumbing company and you've been renting warehouse space for 3 years. An SBA 504 loan at 5.7% over 25 years lets you buy your own commercial building.
Right.
Your monthly payment is close to what you were paying in rent, but now you own the building. In 10 years, that building is worth twice what you paid, your payment hasn't changed, and you have an asset you can borrow against or sell.
It's amazing.
That's generational wealth from one loan decision.
This raises an important question, though. How do you actually navigate getting that loan approved today? Because the SBA instituted some really significant regulatory changes between 2025 and 2026.
Like what? What did they change?
Well, for one, they sunsetted the SBSS requirement for small 7A loans.
Okay, unpack that acronym for us, because that used to be a massive hurdle.
The SBSS was the small business scoring service. It basically functioned like a rigid FICO-style gatekeeper. If your score was too low, the computer just kicked you out.
Ouch.
Yeah. By eliminating that, lenders now have more flexibility to look at the holistic health of your business rather than just one algorithmic score.
Well, just reporting the facts here, that sounds like a win for borrowers, but there's always a trade-off, right?
There is. The trade-off is the collateral. While the automated scoring relaxed, the manual collateral documentation requirements really expanded.
Meaning more paperwork.
A lot more. They also implemented a strict 100% citizenship rule for ownership. Plus, they adjusted the rules around partial partner buyouts and increased contingency requirements on 504 construction loans.
So the bank might be more willing to listen to your story, but you better bring a thick binder of paperwork to back it up. Which naturally brings us to the businesses that don't have that paperwork, or the 2 years of operating history, or a 680-plus credit score.
The ones hitting that credit wall.
Yes, we need to walk through how risk is assessed in the alternative market, because it's not a one-size-fits-all fallback.
It's best to look at the alternative market as a staircase of risk.
Yeah.
If you have decent credit, say 660 or above, and you just need cash in 24 to 48 hours, you're looking at a term loan.
Okay, a term loan.
Yeah, it functions like a traditional bank loan with a set monthly payment, but the term is capped at 1 to 3 years, and the rate is higher.
But what if your credit took a hit? Say you're sitting at a 580. A term loan is probably off the table.
Then you step down to equipment financing.
Mm.
This also funds in 24 to 48 hours, but it's highly accessible even with lower credit.
Why is that?
Because the underwriting shifts from your personal score to the value of the asset. The skid steer or the medical laser acts as the collateral.
But not every cash crunch is about buying machinery. Sometimes you just want to prepare for the unknown.
That is where the business line of credit comes in. It generally requires a 600-plus credit score. You secure it during a maintenance phase, so it's ready for a crisis.
A line of credit is the business owner's sleep-at-night fund. You don't touch it until you need it. But when your biggest client pays 15 days late, or when a pipe bursts in your building, or when you get a chance to buy inventory at 40% off because the supplier is liquidating, you pull from the line, handle it, and pay it back. No panic, no scrambling, no calling your family for money.
Exactly.
Just a tool sitting there waiting for you to use it.
And if your problem isn't unexpected expenses, but rather the timeline of your own revenue, you utilize factoring. Factoring targets the specific friction of accounts receivable. It funds in 24 to 72 hours.
Okay, let's paint a picture for that. You run a staffing company. You've got 30 employees on payroll every Friday. Your clients pay net 60.
That's a brutal gap.
It is. That's 60 days of payroll, taxes, and insurance coming out of your pocket before a single payment comes in. With factoring, you sell those invoices the day you issue them.
Cash hits your account in 24 hours.
Friday comes around and payroll is covered. Your employees never know there was a gap. Your clients never know you factored. You just sleep better.
It unlocks the capital trapped in your own success. But we have to address the bottom of that risk staircase.
The merchant cash advance?
Yes, the MCA. If your credit is poor and you need money on the exact same day, an MCA will fund you. But they do not charge traditional interest. They use a factor rate, buying a percentage of your future daily sales.
With so many fast online options, how do you avoid the predatory traps here, especially when you're stressed out and just want a quick fix?
You have to look at the trust factor. Small business loan fraud surged 13.6% recently. You must look for transparent pricing.
Meaning real APRs, not just these confusing factor rates.
Exactly. If they hide the APR, walk away. You also need to verify physical addresses and check third-party reviews. And most importantly, check the contract for a confession of judgment clause.
A COJ. This is a huge red flag. Explain what signing a COJ actually does.
The confession of judgment is a legal agreement where you accept liability up front. If the lender decides you're in default, a COJ allows them to bypass the court process completely.
Wait, really?
Yeah. They can immediately freeze your bank accounts or seize assets, and you don't even get to defend yourself before a judge.
You literally sign away your due process. That is terrifying.
It's the ultimate predatory trap.
So what does this all mean? We've got the slow, low-cost SBA loan. We've got the fast, high-cost alternative loan. Why do we have to choose just one?
If we connect this to the bigger picture, the most successful business owners in 2026 don't view these as mutually exclusive. They use a hybrid strategy.
Combining both.
Right. They maintain traditional banking relationships for planned investments, but keep alternative lines open for emergencies or bridges.
Here's the play that smart business owners make. You're a restaurant owner and you want to open a second location. You apply for an SBA 7A loan for the build-out that's your long game, lowest rate, biggest amount.
Makes sense.
But the perfect location just hit the market and someone else is looking at it. So you grab a short-term bridge through an alternative lender to secure the lease and start demo.
Use speed to win the asset.
Exactly. When the SBA funds 90 days later, you pay off the bridge, and now you're sitting in your second restaurant with the best financing terms available. Two funding products, one strategy, and you didn't lose the location.
That is capital management at its absolute highest level.
And that is the real takeaway for you listening today. Understanding these timelines isn't just about reading interest rates on a page. It's about matching the financial tool to the exact life cycle and urgency of your business.
Absolutely.
Because if you know when you need the money, what becomes obvious.
It really does. But, I want to leave you with something to ponder. We've seen how AI absolutely conquered that 5-minute lead response time.
Yeah, the front end is instant now.
Right. But as AI integration deepens into actual underwriting and risk analysis, reading bank statements, verifying identities, how long until the 90-day wait for traditional low-interest bank loans shrinks to 90 seconds?
Oh, wow.
Will the dividing line between slow and cheap versus fast and expensive eventually disappear altogether?
A future where the SBA bus arrives at helicopter speeds. That is a wild thought to end on. Thank you so much for joining us for this deep dive. Keep questioning the tools at your disposal, and remember, don't let the timeline kill your business before the loan saves it.